It's my real pleasure to introduce David Gauthier. I've known him for 17 years. He was the vice president of Origin Ventures, which is an ag and food tech major fund in Canada. And he was my boss at IRAP for a while as a director. And he founded and was the executive director of the Entrepreneurial Foundation of Saskatchewan. So he really knows what he's talking about when it comes to training entrepreneurs. And now he's a vice president at Natural Products Canada, which is a great organization that we've known for some time and are having great results. So without further ado, David Gauthier.
Mark, thanks Amy, and thanks to Innovation Place and IRAP for pulling this together, and to all the communication partners who got a pretty good turnout today, both in-house and online. So I'm going to be talking an awful lot about risk today. And we all know, I think, that entrepreneurship is a risky venture. And it's not just because of the inherent risk of the business. Many entrepreneurs fail because entrepreneurs often have this other quality about them where they try to be positive, they try to be determined, they try to ignore the bad stuff, focus on how successful they're going to be. And so in many ways, they are avoiding and not looking at the controllable risk within the organization. And I think that contributes a lot to some of the high failure rates that we see. And it's not just entrepreneurs that can do that. If you remember back to 2008, some of you might be too young and maybe have investment portfolios that were completely destroyed over the course of a few months in the fall of 2008. But the whole financial crisis was based on everyone ignoring all of the risks around the mortgage securities. Everyone was making money hand over fist. You were dumb if you didn't have 10 houses that you would have bought and put on the market. The financial institutions, the regulators, and the federal government, everyone just let it go until it all came crashing in. As a result of that, new regulations came in. We started hearing things like Sarbanes-Oxley rules. Canadian GAAP started to change. And across all kinds of organizations, whether it was a private organization or even in the not-for-profit sector, where risk management and risk assessments started to creep in, and they became a necessary part of the disclosures in your audited financial statements. So a lot of things I'm going to be talking about today kind of happened because of that, and organizations have developed some pretty good tools and ways, and boards are supposed to be looking at the riskiness and doing risk assessments on their business on a day-to-day basis. So it really does provide a good framework for how you can anticipate as much risk as possible and have enough time to be able to mitigate some of those risks.
David, would you mind just fill out here?
Okay, absolutely. Talking to the crowd, not to the microphone. So I'll talk to the people that are way out here in virtual land across the country. So I'm going to start out by talking about some of the investor perceptions of risk. So in the very early stages, you're reaching out to external investors, and it's very important for you to understand what their perspective on your business is. So if you look at this diagram, every investor lines up into what they consider to be an appropriate balance between the riskiness of your investment and the potential reward that they can get from that investment. And that yellow blob in the middle is kind of where different investors would park themselves. So a venture capitalist would be in the top right corner, willing to take an awful lot of risk, but also expecting to get a big return on the other end. And down in the lower left corner, that's where you get your traditional banks and bank loans. Very low risk, and they're getting a very little reward on that investment that they're getting. So the reason that that yellow thing is not a line, it's a blob, is saying that there's a negotiation range that can happen depending on the perceptions of risk and reward by those different investors and how you position your company. If you're on the green side, it's a real hot deal. And if you're on the red side, then it's not a very good deal, or the investor is investing in or providing capital for reasons other than financial return. So it's very important that you look at the different perspectives that different investors have when they're assessing risk, okay? So in terms of banks, it's all about, are you liquid? Do you have cash in your bank account to make that monthly loan payment? That's really all they're very concerned about. When you get larger companies that are listed on public markets or looking for institutional investment, it's all about growth risk. How can I grow revenues of my company through actually producing more product or by acquiring other entities to increase the value of my company? And that's what the whole startup market is based on. If you're in venture capital, it's all about when am I going to get my money back? And it better be within 5 to 7 years, and it better be from 10 to 100 times my initial investment. That's the way they look at risk. If you're looking at government programs, that's where they might be investing for things other than financial return. It's all about their program. If I invest in this company and something goes wrong, is it going to get into the front page of the Gazette and make me embarrassed and embarrass the company and embarrass the government? That's the way they look at things. Founders and family and friends are a little bit of a mix. They could be investing for financial return. They could be investing because they like you and they want you to succeed. They'll be very sad if you don't succeed. They might be very angry at you and ruin your whole relationship with them if you don't succeed. In terms of large corporations, they're looking at competitive risk. If I partner with you or invest in you, does that give me a competitive advantage against my competitors, which are other large organizations? Or if I don't invest in you and they do, does that actually hurt me in terms of a competitive situation? And angel investors are basically a mix of everything. They can be investing for financial return. They can be investing to give back because they like you, they want to support you. They're really a mix of all of that. So this is a little bit too simplistic. There's a lot of nuances in there. Many investors look at things in different ways, but it's important to do your research before you talk to them. And in your first conversation, listen more to them about what their questions are and what they're concerned about, rather than trying to give them the big hard sell on your company right off the bat. So in the normal sense of things, most entrepreneurs start up in that green side talking about what a hot deal this is and how you can't possibly fail. So they're trying to move that yellow blob up into the hot deal area. Investors, on the other hand, they've seen this before. They want to know what are the risks, what's going on, what's happening in your company. What about all the competitors that are out there that are already doing the same thing? So they're pushing on that other side of that blob down into the red zone. So right away, there's a problem there. You can see that the company is going in this direction and the investor's going in the other direction. There's no way of doing a deal and having a partnership with someone if they're talking about something and you're talking about something else. They're asking you about the 15 competitors and you're saying, well, gosh darn it, we got the attitude and we're gonna show those guys and we're gonna be the ones to win. And they're saying, yeah, but they're all doing exactly the same thing and they're already large. They already have millions in revenue. Well, we're gonna beat them. We're gonna show you. So that conversation simply is not gonna work. So here's how the conversation has to go. You can still negotiate, but you have to be pushing back on that horizon from the other side. So basically, the conversation goes like this. Hi, we're in this sector. Yes, we know there are 15 companies out there making lots of money, but they're all using the same data technology that creates a very expensive product. We got some brand new patented technology. We've got a scientific or chief scientific officer who is like the best person in the field on the planet. And we're confident that with investment, we can develop this product at 1/3 of the cost. And it's also going to be sustainable because of the way our process goes. So right off the bat, you've taken away all of that, so a lot of that risk that the investors come in with. It shows you, demonstrates to them that you understand your market, you understand what your competitive advantage is, and what you can provide them on the other side. So that's the way a mature company approaches the conversation. Okay, so just to sum up that section, The best way to increase the perception of risk is to pretend that it doesn't exist and be unprepared for that conversation. Best way to reduce risk is to acknowledge it, embrace it, understand what's going on, and develop strategies to deal with it. And you got to be prepared to be realistic about your opportunity as you go through that due diligence process and hopefully do the deal. So I might just pause there for a second to see if there's any questions either on the chat or in the room just on that section. If not, we can carry on.
No question.
Good. Okay, great. We'll just carry right along. Okay, so financial risk is really the risk, right? It's really the only risk you're worried about in a company. If you don't have cash flow to keep the company open, then it's all over. And all of the other risks of different components kind of roll up into that overall financial risk. So as Warren Buffett said, accounting is the language of business. So who am I to argue with Warren Buffett? All right. It's important that all entrepreneurs develop a certain level of financial literacy. Doesn't mean that you all have to become chartered accountants. You can hire people to kind of help you out, but you have to understand how basic sets of financial statements work and be able to use that language when you're talking to your investors, when you're talking to your board, but more importantly, make decisions for yourself based on your financial situation. Okay. Many entrepreneurs manage their business by how much money is in their bank account. Other people are very afraid of financial statements and think that it's complex. So they outsource it to an accountant. And although they might get statements back on a monthly basis or a quarterly basis, they might not really understand what it says. And that also prevents them from making decisions on a daily basis. So you have to become familiar with how finances work, be able to, on a daily basis, look at that information so you can make decisions going forward. So I'm not an accountant myself. There's some in the room who might be very angry at me for the next 4 slides I'm going to show you. But here's a cold note version of the 3 main financial statements. I know that most of you may have seen them before, but I want to make sure there's a common understanding in this room and online about what we're talking about.
You can cover something here first.
Sure, please do.
One of the things used to drive me nuts, but basically, if a person's only getting their numbers once a year, it's called a box job. If you're an accountant, like with CPAs, we used to call them a box job. People bring in a box with all their receipts and stuff, and you prepare the statements, and then these magical statements come out. Well, very useless because they're a year old, but you're not making decisions. So you have to be getting at least monthly financial statements. If you aren't, it is suicidal. You are likely going to fail because you need that information on which to make decisions. People say that I can't afford a CFO. That's true. Tier 1 CFOs are in the hundreds of thousands of dollars. You don't need that till you're in the multi-millions of revenue, but you can rent them as a fractional CFO. Get somebody that knows more than bookkeeping. If they're doing bookkeeping and producing the statement, but not helping you with your KPIs and reporting on your KPIs and your data on a monthly basis, they're not a CFO and they're not providing you the information. They're basically producing a set of statements, which is fine, but there's no information coming out of that. So you do need to hire quality in the forms of a CFO that knows business, and if they know marketing, that's also good, so they can help you with the KPIs. So you need that information on a monthly basis, and you rent it. Everybody expects you to have a fractional person, especially at your seed round. Your pre-seed, maybe not, but your seed and Series A, you're going to have a fractional CFO that's got a pedigree and not Joe's accounting service.
From an accountant. All right, it's official. So the first statement is called your balance sheet, and start out with the asset side of it. So you have fixed assets, that's furniture, that's real property, something you can touch and feel. So you want to categorize those in terms of what your fixed assets are. And then you have what's called current assets. So these are things like cash, accounts receivable, money that is basically owed to you. And basically you add all those up and you have a total assets number on the bottom. So that's one side of your balance sheet. The next side of your balance sheet talks about your liabilities. So you have current liabilities, which are money that you owe to other people. And then you have your, you can use that number to come up with your net assets. So this would add on to what was on the previous page. And then you have to look at how you're actually, sorry, speech louder, sorry, I have to into the slides, that's the problem. I need a screen there. Look at how much equity investment you have had and how much net profit you have had at the end of the year to finance all of those assets. So these two numbers have to balance. Your net assets and your total shareholder equity have to balance, and that's why they call it a balance sheet. Moving right along to the income statement, also called often the operating statement. This is where you look at how much money you've generated by sales and counter that with how much money you've spent on non-fixed assets, sort of to operate your business. And you subtract the total expenses from the total sales, and you end up with your net profit or loss on the bottom of $8,000. And then lastly, we have a statement of cash flows. So this looks at how much cash is coming into your organization and how much is going out. So you start with your net income or loss. You add back in what you spent on your fixed assets, and you'll say, Dave, you got a mistake. You got $6,000 there, but you only showed $5,000 on your balance sheet. That's because we deducted $1,000 for depreciation on that one. So you add back in that depreciation, and you end up with a total on that. And then you look at your owner's equity, and that kind of shows all the ins and outs of your cash flow. So these are your three kind of static statements that you're generating on whatever time interval that is necessary for you. But where it comes to risk and managing risk, it's all about how can you project into the future. Once you have an understanding of those statements, how do you take those statements and guess what they're going to look like next month? Guess what they're going to look like next quarter? Guess what they're going to look like a year down the road? And the goal is to come up with something like this. This is really a snapshot of the evolution of most companies. When you're starting out, you're in a cash consumption stage. You're not generating any net revenue yet. You're using cash to actually build up your business. And that gets deeper for a while. Eventually you start selling something, so it doesn't go quite as deep. It starts to take off a little bit. And then you hit that break-even point somewhere down the road. Then congratulations, you're finally a company. You're finally a company when you've actually started to produce more cash than you consume in building that business. And then hopefully until you decide to expand again, then you may actually start going into negative territory as you build a larger facility, etc. But it's very important to know what that curve looks like. When I started a consulting business back in 2012, I needed to buy a cell phone and a computer. So for $700, I was up and running. 2 days into my first contract, I was already cash flow positive. Okay, so that's a very simple example. But if you're a drug development company, you're going to absorb $1 billion to $2 billion of cash flow. It's going to take you 12 years, hopefully, before you actually get approved to go on the market. So you're going to have to generate many billions of dollars on the other side of that in order to have a successful pharmaceutical company. So those are two extremes, and most companies are in the middle. But if you don't think about what that looks like, and you kind of take the first step into the valley with a check from a family and friend, and then you find yourself in that pit, and there's no way of getting out of that pit, your business is over. You really have to understand what you need to accomplish along the road to be able to subsequently get more and more rounds of financing to hopefully get you to profitability. So I've kind of lined up the different kinds of investors who are likely to invest at those different stages of development, just so you have an idea generally where you should be going as you develop your company. And so here's how you go about creating that forecast. You basically just take your cash flow statement and you look at all of the inflows of capital and all of the outflows of capital. You put that on a chart that expands it out over the years. And this is what you and your board are going to be focused on at every meeting. I projected in the second quarter, we were going to have 500,000 in sales. We only had 2,000. Back in the first quarter, if you do the math here, we would have projected that we would have 400,000. We had 300,000. So the discussion back then was, well, we're pretty good. We're a little bit short. We expect that we're going to be doing better next quarter. Next quarter got worse. So now you got yourself some problems. So your whole discussion, or much of your discussion with the board, is going to be around how did you do compared to your forecasts? And what did we learn through that process so that we can hopefully forecast more accurately as we go through? And if we have a problem and that we are now not generating the revenue that we need, what steps can we take today to make sure we stay alive? Can we go to our bank and can we get a moratorium on the interest for a couple of months? You know, can we go out and find another investor? Are there people that we don't need to be paying, you know, that we can lay off and keep only the main people? But you need to foresee those things so that you can take that step in time. Okay, pause there for some questions or comments.
One thing on the cash flow statement that's important is that you do the statement first without investment, and it'll outline where your trough is, like where you're going to basically need the money. And you have to work back 6 months because of the fact that it's going to take you 6 months for a major equity raise. So if you're forecasting a $500,000 deficit in 9 months, you don't have a lot of time to basically start the process of raising the money so you have it when you get hit with that trough, assuming everything else goes well, like that the sales hit. If the sales don't hit, then it's obviously worse. But you do have to forecast, like you do that number first. Don't start putting investment numbers in your thing first. You always work your raw costs and then come up with what your deficits are. Then you put in the amounts to make sure that you're at break even or better. A lot of people make that mistake because you'll start going through and you'll forget where you put the investment amounts. And some people have said, well, I'll bring in $1,000 a month. Well, that doesn't work. Like investment comes in tranches. It's not, you know, even. So you can't force them.
We do have some online questions. The first one is, there's nothing in there that would show where inventory at its different stages goes. Does it get treated like other assets, i.e. furniture?
Yeah, okay, so now it is slightly more advanced in terms of valuing your inventory first in, first out. So it is an asset for sure. It's inventory that you can sell either in the future or sell to somebody else. So it is a tangible asset. But it gets another level of complexity to talk about how you value that inventory over time. So it's different from depreciation of other regular equipment. But that's beyond my pay scale. I haven't done that since my MBA.
And it is a current asset. Inventory is a current asset because you assume that inventory is sold within a year. If it's not sold within a year, you kind of have a problem with your business and business model. So it's a current asset. Anything that is used or consumed within a year is a current asset. Anything that lasts for more than a year is long-term assets.
Okay, and the next question, 2 out of 3, is if we're not having any sales income, only our own funds, how do you represent that?
If it's only your own funds that are going into a company, that's going to be shareholders' equity that would go in. Or a shareholder's loan if you're planning on taking it back out.
Okay, I'll let you know if there's a follow-up to that.
Okay.
And then the third question is, when figuring your inventory, do you use cost, wholesale, or retail?
This is the count.
When figuring out your inventory, do you use cost, wholesale, or retail?
It's cost.
It's cost, but when you, it's definitely cost, but it depends on what you're building, like what your inventory, like if you're looking at expensive, you have the stuff already in the market as well with costs. So it becomes very complicated. And then you have to depend on manufacturer, you have to depend on traffic, get costs like your labor, your hours you put into, but then versus the overhead, and so it becomes very complicated. It is a very, I have to say, inventory would form that to assess that income and stuff.
Okay. So for those who couldn't hear me online, if you wouldn't mind just sending an email address to follow up on that, we can do that. And that's it.
Okay, thank you. All right, we'll move into the last section. This one's not very long, but it's all about how you deal with strategic risk and really how your board can help you with this. So again, after 2008, we started seeing more of these kind of frameworks popping up. There's all kinds of different ones. Some of them have little bubbles, and the size of the bubble reflects the risk, and they'll have different groups of bubbles around different areas of your business. But here's just a nice simple one to kind of show you how you might set up a risk assessment framework for your company. So you're really trying to, again, look at what are the risks that if this happens, it's going to sink my company. So that's something that, you know, is something we should be paying attention to. And then there's also, sort of the legend disappeared on this one. So this would be, what is the impact on your company if this thing happened? And this could be the probability of that thing happening with your company. So if it's going to sink your company and it's likely to happen, that's why it's red up in this corner. Things that are, you know, relatively low impact on your company and low risk of happening are obviously down in this realm. And then there's this medium bit where, yes, something is a little bit risky. It might happen. We got to start paying attention to that. So that's the idea of the color coding, is you would spend all of your time at the board meetings really worried about these two and making sure you got plans on those two, and talking also by why things may have moved from a green to a yellow or from a red to a yellow from your previous meeting.
Can you repeat the X and Y?
Yeah, it really, you can go either way, but one of the dimensions is the likelihood of this event actually happening. Mm-hmm. And the other is what is the impact on your business. So an example might be, again, back to the pharmaceutical example. If I don't get regulatory approval, I'm out of business. And there's a high probability that could actually happen. So my business is solely focused on making sure that the clinical trials are being well run, making sure the data comes back, is informing us before we take the next expensive step down that path. So for a pharmaceutical company, very important. For the average entrepreneur, regulatory is still a dimension, but it might be more about, am I in alignment with labor laws? Am I, if I'm running a restaurant, do I meet all the food safety regulations? So it's important for your business, but it's all knowable and it's under your control. So if something is under your control, or paying your taxes, right? I mean, if you pay your taxes, you're not getting in trouble. So there's a lot of some regulations where you can control it. So you're not so worried that you're going to get lost. So again, that just in that one area, it could be very high risk depending on your business or very low risk. For some businesses, it's can I get the right people? Losing people is really internally. For other businesses, it might just be all about gaining customer traction. It's the thing that you're focused on today. I think more customers. So I need more people to go out and sell them. So every business is going to be different. You have to decide what are the key elements of your business and start thinking about how important is that the success or failure today of my business. And it might change next month. That's why you're constantly updating your matrix so that you and all of your staff and your board are trying to solve those most critical issues.
There's another question in the chat. Are there restrictions on how money can be used once it comes into the company? If there's a surplus of revenue, is it possible to bonus out employees and founders?
Okay, if an investor is investing in you, they will often set out what's called a use of funds in the agreement that says, we expect you're going to be using this money to, improve your technology. They're normally fairly general, right? You're going to hire staff. You need to do this, you need to do that. They're basically a summary of what you've agreed to, what needs to be done during the due diligence process. Because again, the investors want to know that they as a group are providing you with enough funds to be able to get yourself to the next milestone where you can raise more money or hopefully eventually get to market. So a lot of that is worked out in terms of the budget that they might set for the use of that funds, but it is kind of laid out there.
So sorry, they sent a follow-up and said that, apologies, I wasn't clear. I meant income and not investor money.
Okay. So, again, it depends how the investment is structured. So sometimes people get dividends, and dividends can be paid out on their investment on an annual basis based on some target. And if you meet a revenue target, maybe that could be part of the deal. If you've done really, really well and you want to give bonuses to your staff, if you're a sole entrepreneur, you can do whatever you want. But if you have investors, they might want to agree to that in terms of setting up your company. What are your HR policies? They're probably going to want to know that up front that, yeah, at the end of the year, if we meet these targets and we have sufficient cash flow, we think a 10% bonus for everyone is the right thing to do. So a lot of that stuff gets worked out at the governance level. So it's going to be your board that is helping you develop your HR policy, all of your other policies, and kind of set out some of those parameters. And it is possible that an investor going in would set some limits or parameters around those policies.
And usually it's based on the budget.
Yeah, I also want to add, it depends on if you have a loan with the bank as well to help you grow your company. If you have a loan with the bank will want to make sure you go to the bank first. If you were going to give their dividends, and get the bank to go first. If you have a loan with them, because the bank wants to get paid first. So you want to make sure there has to be agreement that is set up with your company.
One thing I've also noticed that I've had a lot of entrepreneurs get surprised that the CEO and sometimes the VP's salaries are approved by the board. That is a surprise to a lot of entrepreneurs, but if they've invested in the company, there's usually a budget set, but they're not going to allow you to take 200 grand a year as a salary. Basically, as a first-time entrepreneur, they're just not going to do it. So the salary of the CEO for sure, and maybe the VPs will be at the board discretion. That's usually in the term sheet. You'll notice that in the term sheet or in the investment document. That's the only time I've really seen. And then sometimes approved budgets is been in term sheets. But other than that, they're pretty. They're trusting you to run the business.
Lisa, thank you.
Okay.
And there are more questions, but I know we need to get through some more slides.
Yeah, it's really just one more slide and then we can really open it up. So using your board to reduce risk, Blair last week talked about setting up a board competency matrix. So to how you can use different criteria to select who is on your board. You really want to now utilize your board to figure out how you can extend your networks to other people. So you might want to set up various advisory boards so you can have the same kind of matrix for what you are looking for to make sure you have the right people on those various boards. And then it also involves all of the other informal interactions that you can have with people. Because one of the biggest risks out there is to not have a line of sight on something. If everyone's sitting around you on the board or your advisors all think the same way, then you have blind spots. So you need to open yourself up to people who are even in different industries because they don't have the same groupthink that you have. So the more of those different diverse people you have around you, whether they be formal advisors, whether they be mentors that you seek out and have a drink with once a month just to chat about your business, become part of organizations like Startup TNT, angel networks if they exist in your area, just to be around other entrepreneurs. That's where a lot of learning happens. And don't be afraid to share your bad stories as well as your good stories. That's how we all learn. And it's kind of, I think it's giving back to the community by sharing your bad stories. That's something that can help another entrepreneur not make the same mistake. So don't be afraid to talk to as many people as possible and surround yourself with good folks that make sure you don't have any blind spots in your business. So that was really it. I do want to acknowledge the Entrepreneurial Foundation of Saskatchewan that Mark mentioned in the opening comments. When I was working there is when we developed a lot of this material. It's been on the shelf for a while, so it was happy to dust it off and kind of put a twist on it in terms of corporate governance. So, but just wanted to acknowledge them. It was a great place to work while I was working there. And maybe just a final story. When we wound down the foundation, the decision was made through forecasting. We were in a situation where we had 2 new grants. One of them we had actually signed. The other got held up in the writ when the election was held in the fall of 2011. And I laid out a 4-month cash flow scenario. And I said, what can I guarantee is coming in? What can't I guarantee is coming in? And the decision was, I advise you, board, we got to wind this thing down. So the first thing you need to do is give me notice so that you are not on the hook for the pay you would owe me if we ran out of money. We had a very civilized wind down. People had lots of notice. We sold all the furniture so that the board didn't have to worry about that. So forecasting isn't always end up with good things, but if you see that the writing is on the wall, it at least gives you time to sort of wrap things up in the most friendly, civilized, easy way as possible, and then move on to your next challenge. So
There's always
just wanted to share that little secret too, that forecasting works both ways.
And there's always life after your first venture.
Okay.
Okay, so just a couple of questions online. For an early stage company, says only safe notes in. I'm not sure if that was supposed to be added to the question. If you're a founder with a co-founder, is there a benefit to having a board? If you don't give board seats, it seems like there's less meddling in your business.
Yeah, I mean, that's the wrong attitude. You don't want directors to meddle. You want them there to help you. And so when people force themselves on the board, and occasionally there are investors on that board that are driving you crazy. And because they might only be thinking about their own best interest. And you do have to watch for that. But in most cases, when you're with most entrepreneurs, you're pulling together a board of people that you want to bring together. So you want to have, someone who has some understanding of operating a business, someone who understands the finance kind of point of view, and probably someone on management or HR. I mean, those are kind of three skill sets that would be very helpful, again, in providing advice on different aspects of your business. Yes, people can force their way on the board, but that's the cost of getting their money. And they're going to be on the board to make sure that their investment is being well taken care of. And you're just going to have to deal with that. That's, again, a cost on your side of taking investment on. It's not saying that all investors are bad board members. I mean, many of them are very, very good. Many of them are well connected in the finance industry to bring more money to the table. But every director, because they're a fiduciary, has to be focused on the success of your business. They do have to put their self-interest aside And if someone does start sounding self-interested, the rest of the board has got to make them aware of their fiduciary responsibility and sort of reset the lines and the barriers on the conversation around board.
And likely they don't control the board. Like even if you bring in an investor, they might get 1 seat out of the 3 or 1 seat out of the 5. So they likely won't control it. They can cause you grief, but sometimes it's good grief and sometimes it is disruptive, and that's where the other board members need to be strong enough. And we're going to cover, I think, some of that next week and what can go interesting or wrong.
Awesome. What are the risks of accepting investors' money, and how should a sole entrepreneur approach this to minimize the risk and ensure the growth reward of taking outside money?
Yeah. I think some of this was discussed maybe last week, but you certainly have to do your due diligence on the investors as well. So you have to make sure there's someone you want to work with. You can look at their existing portfolio of companies and talk to those people. Generally, the ecosystem will kind of know who are the harder investors to get along with, who are fair, who is kind of operating in your sector. So you have to do an awful lot of diligence on them. And as you go through the process of diligence, that's where you're building a relationship. I mean, it's a marriage, right? You're both coming together to work on this thing, and both of you want it to be successful. And you have to agree beforehand how you're going to make it successful. So this is where defining what the funds are going to be used for, defining who's going to be on the board, having that shared vision is what you need at the beginning. If you don't have that shared vision, you shouldn't be taking their money. If you know they're going to want their money out in 3 years and it's going to take you 10 years to get there, what's the use of taking their money? And they are going to make it.
And it all has to do with what David was saying with regards to your forecast. If you can do it on your own, your family's money, whatever, you may not have to take investors on, but that is extremely rare. So you need to forecast how much money you're going to need to get this product out there and to the extent that you want it to get to. We run into entrepreneurs that want to run a lifestyle business, which is basically where you want it, where you can manage everything and you want it to only get to maybe $500,000 in sales or $1 million in sales. That's not an investable business. It has to be much bigger than that. Your vision has to be bigger than that. If it isn't, you're right. You probably shouldn't be taking investors' money because you have to get big. Like I know with a lot of companies that I'm dealing with on the venture side, you have to have the potential to hit 50 to 100 million in sales if everything goes well. And that's a venturable business because, if they're investing $1 million or 10 million, it has to sell for at least 100, so it has to get that big. If it isn't, it is what we call lifestyle business, which is you can make a good income. There could be 3 or 4 people working and all making $100,000 a year or something like that. And you're happy at that. That is a business, but it's not a venture business.
I just want to add that I think you had to start with the end in mind. So you needed to know what you really want and be firm about it, like be flexible as well, but be firm. But you want to really do the due diligence, like David said, investors, what they want. So you want to make sure the interests are aligned at the very beginning. So that's how you manage the risk of this investor. And in terms of forecast, so, you want to make sure I always give our entrepreneurs that you can forecast, we should have your worst scenario, your somewhere in the middle and the best scenario. So the investor likes to see that. So they can see, what the worst thing could happen if I invest money in you and what's the best outcome. So you have to have a set of forecast. So like, our friends will have the money, we have to invest money, and that's going to be the best outcome. So So you have that kind of projection, and I think managing risk with your risk when you take the horse, what they have to say about what goes into your forecast is very important. When you're developing your forecast, there are a lot of assumptions go into your forecasting. So what are those assumptions that do you agree with your risks, like your investment? What assumptions that you should get back to something like have of this opportunity?
Yeah, since 2020, we've been through, a dark comedy of unprecedented economic kind of conditions. I'm thinking challenges that we face are the supply chain disruptions, interest rates rising at kind of an unprecedented rate or unexpected rate, inflation, certainly others. Those are pretty macroeconomic things, but they make pretty big swings when you are trying to forecast, over the course of even a year in terms of where numbers end up. How does kind of the small business person, you say, or startup take those into account in calculating risk or in forecasting?
Yeah, again, you can't forecast the unforecastable, right? So that's, or at least at that point in time, if you think you have a secure supply chain, it's not at that top right of that risk matrix. And then something like that happens, all of a sudden it's right up there. It's the most important risk to your business. And yes, then you have to be smart and agile to try to adjust to that and respond to it. So, the timeline that you learn something and react to it varies. You don't always have the luxury of seeing 6 months down the road and making that change. And that's where that entrepreneurial, I can do it attitude comes in handy. It's dealing with those unforeseeable risks. So there's not much you can do about that. All you can do is control what you can control. But you'll be smarter next time, right? So once some macro thing comes in and punches you in the face, yeah, some people went away because of that. But the ones that survived are probably going to be way better off because the chances of the frequency of these things happening seems like it's increasing a little bit. Things are a little bit unstable. So having diverse supply chains is a good thing to do. So.
And one of the things that was discussed at the Banff Venture Forum a few weeks ago was that in tough times, the biggest and best companies are always formed and are always, if you get through this, you are usually way better off than drunken failure like it was in 2021, 2022. You spend better, you control your cash better, and you're set up for long-term growth versus growth at all costs. If I ever hear that again, it's cash is king now. If your board isn't advising you to conserve cash for the next 18 months, they're the wrong board right now.
If I may add a comment on this too, Ben also does a bit of a counterpoint to the person who mentioned that I have a board in the middle of my company. In these troubled times, this is exactly when you want a board. In large part because the board usually have people that have seen this happen before. The economy runs through cycles, right? Yes, these are unprecedented events, but they're not relatively unprecedented when you look at the historic economic cycles, right? And so if you've got somebody on your board that has 20 years experience in venture capital and has seen multiple things happen before and can give you ideas on how you navigate some of these tricky situations, and you'll get through to the other side. And so that's not just to you. I know you probably know this, right? But just to say to the room.
Everyone,
right?
Those folks were saying straight, so be low for a long time. Not that.
Sure, that too. Yeah. So you got to make sure you got the right people on your board, right? And you weren't just taking money from everybody that was saying growth at all costs, right? Because if those people are now also telling you still growth at all costs, and you got the wrong people on your board. Yeah.
I'm interested to know in the group, everyone was saying, well, this will be good. We will start developing local supply chains. We won't be as reliant on Asia for some of our products. Does anyone actually see any examples of that happening? Because I'm kind of worried that now that things are kind of getting back to normal, that maybe we do still have a blind spot and we haven't done anything about it. Or maybe there's nothing you can do about it because it's so dominant. So I don't know. Has anyone seen anyone creating local supply chains around circuits? Or
I mean, it's been good for us
Yeah.
as a local
like
supplier.
a local supplier
Yeah,
services?
that's been a good
Yeah.
side of it for sure.
Yeah. You get more business out of it because people are looking locally for services.
Especially just left, but I know SolarStar has seen that happen with their, and also seeing more traction on the sales side with procurers in North America wanting to buy from suppliers that are in North America.
And a lot of this will settle out when that plant in the state gets built, that integrated circuit company.
How do you forecast your revenue if product is at commercialization stage?
Yeah, there's forecast and then there's kind of like, what do you want to do as a company, right? So your forecast could just be, here are my targets. I want to be growing at 20% every quarter. That is my target for my growth. Am I meeting that or not? And then how do I recalibrate to meet that target? Versus if I don't get the 20% increase, I'm out of business. So it depends what you're trying to achieve out of that forecast. So again, what they should be, I don't know. It's up to your individual circumstance. But you always have to know, when do I run out of money? And how long can I survive having low revenues per month? And just doing that simple calculation. So again, it's going to be a little bit different in different circumstances. There's no right or wrong. But just sitting down and thinking about it is probably as much as what actually goes, in terms of your guesses for what's going to happen next quarter.
And you got to work at units. It drives me nuts when I see a forecast that doesn't have units in it somewhere. Like, I insist on the decks that I'm approving is that you've got sales by product line, a stack bar chart, but I want to see the units, like, in a line chart across it, where you basically know what those units are. So are you selling 4 units and that makes up your sales, or is it 1 million units to make up that sales? In Beverly Hillbillies talk, it's the gazillion. The numbers that go behind it are really critical, and the board can help you with that. Because if you say you only need 1,000 units to do that, and they say, well, you could easily do 2,000 with this, it changes everything. So you've got to be talking in units, and then that way you can forecast.
And just to add on that too, your forecast is a hypothetical thing, so it doesn't have to be accurate. So we know it's not going to be accurate, and know it's going to get changed. But most importantly, it's your thought process. Like, the investor, when they look at your forecast, they just want to see what you're thinking, like what you're thinking, how you think. So they're so important, that is. So yeah, but it doesn't have to be accurate.
Another thing that is really critical with that is you need to have a ballpark idea what that unit's going to sell for. I have ran into a lot of R&D type companies where they're developing a product that they don't know what it's going to sell for. You're dead meat, because the fact is you need to at least know ballpark whether, if you spend $1 million on developing it and there's only a market for X, you've got to know what it could sell for. Like, if you can't guess that, you'll never be able to do a forecast. I think that's what they're talking about, commercialization. If the product's not developed completely yet, you have to at least have a guess as to what it's going to cost, ballpark, and that'll usually be off, but you got to know what it's going to sell for.
And then, do you have any recommendations on good accounting software for early stage startups?
What people use here, it's Simply Accounting and QuickBooks seem to be the two that most people use.
We do.
still have 18 people online.
It's not like you're just talking to us.
Yeah, so that's, and again, what's nice about these packages is, provided you made the entries right, you just hit click and you get your 3 statements that come right out of them. So they're very handy.
No, it's fine. Well, a lot of the companies we talk to are using QuickBooks. or they have a firm that's paying for them.
And you like to be able to hire people and how to operate those versus something that's really audience.
Yeah. And there are there are firms out there, like MNP is a big supporter of ours, and they have packages for startups that are very reasonable in terms of rates. Right. You know, same on the legal side with like Mercurger. But I'll just mention on the accounting side of it too, is just be careful, like try to have both your accounting and then also like your own sort of cash flow model of how your business runs. Because those things aren't always directly correlated, right? And the sort of the day-to-day and some of those, you know, the way the bank updates into QuickBooks or whatever, and might not always be there. And also the way that QuickBooks identifies, especially if you've got different SKUs of products, QuickBooks can't always separate that out nicely for you. And so if you're actually trying to get a snapshot of your business and where you're making money and where you're not making money and which products you should be focusing on, you need to have a separate model for that. Right? So most people create a spreadsheet model.
One final question online from our silent moderator, Colleen. Do investors often help their investees create financial models?
Absolutely. It's going to be part of the diligence. They're going to want to see your 5-year forecast to see, again, are you meeting a milestone that's going to allow you to get more financing or become cash flow positive? Whatever you give to an investor, they're going to look at that and they're going to say, okay, that's very nice. It's going to take you 3 times as long. You're going to make 3 times less than what you say you're going to make, and it's going to cost you 3 times more than you think it's going to be. And then they'll start there in terms of what they think the value is looking like. So, you know, you've got to put your best thing down, but, you know, no one ever meets their projections. I don't think I've ever seen a business plan that had a 5-year projection that was anywhere close to what it actually was. It's always going to take you longer. So you've got to understand that. Just because you can throw numbers into a spreadsheet and it looks great, you got to realize that there's a lot of risk in achieving those numbers. So this is step number 1. Recognize it's not going to be great and accept that. So you may have to go out sooner than you think to raise more capital. You may need to think twice about buying that expensive storefront in an expensive mall right off the bat until you kind of prove that you have a client base. So, you know, in your very, very earliest stages, if you adopt this risk mentality, that'll save you from failing quicker than it needs to.
And I can say that in 45 years that I've been doing this, I have never seen anybody hit projections.
But it allows you to look at the mechanics. I think what's good about it is you can say, like, what is most important to this company? Is it really revenue driven or is it really cost driven, right? And or is it margin, like what really is affecting those margins? So it can really help you think about how a business works and operates. So it can be useful in that way, even if the overall targets are kind of, you know, just made up. That's it.
That's it. Okay. So for everyone, thank you so much, David, for being here today.
Thanks for having me.
Hopefully everyone can join us next Thursday for the last 2 sessions online over the lunch hour. We'll be avoiding the bad stuff, so what not to do. And then we'll be in Balkans in the evening. We've got drinks and appies and networking. So if you can make it in person, we don't want to miss you. Otherwise, we'll see you online.